Good day to all. Today we're going to discuss about valuing bonds, or we can also say bond valuation. They mean the same. Overall, we want to determine or get the value of bonds with certain methods. But of course, we have to know first the basic concepts. So let's begin. So valuation basics would have a review of the following terms. For us to be able to get or determine the value of bonds, we have to know these three terms. We have the present value of future cash flows. Well, you know these already from the previous topics about time value of money. So if we talk about the cash flows, which are actually in installment or periodic payment, which would be equal actually. So we will have to use ordinary annuity then. And then if in advance, that's annuity due or annuity in advance. If we only have single cash flow or one-time collection or payment, then we are going to use PV of 1, present value of 1. And then we also have to take note that if the amounts are not equal with each other, so we are going to make use of still the PV of 1, and we are going to get the sum of each cash flow of certain number of years. So that's how we are going to get the present value of future cash flows overall. So much of that has been discussed in time value of money. Next is to link risk and return. So in investments, just like bonds, which are actually fixed equity, and then we also have the debt instruments. So if we say debt, that's the fixed instrument. If we say equity, that's the variable. So that's why I said fixed and then also the equity. So those are two separate types of investments. But then we can also say bonds and stocks. So stocks will be discussed in the next topic or chapter about stock valuation or valuing stocks. And then stocks or shares, the IAS term, International Accounting Standards equivalent, in which I will be using then stocks because stocks have been used in US under US GAAP. So we are going to use the terms interchangeably. Although the book or our source is from US, hence what we will be seeing will be the term stock. So much for that in the next chapter. For bonds, these are fixed instruments in which we'll be getting the cash flows out from principal and interest. So this is one thing that we should remember as opposed to stocks in which the cash flows will be obtained from dividends as shares from the profits of the corporations as well as the capital gains. So any increases on the values of the shares because of the profits accumulated over time, of course. So again, discussions will be given for stocks more in the next chapter, but this is just to oppose the two basic types of investments because we will be tackling them starting from this time and the next chapter. So at least you are now able to differentiate the two at the onset or from the start. So in terms of the investments going back, we have the bonds risk and return. There is a direct relationship between the two, such that if the risk would increase, the returns would also increase. It's like the risk would be the independent variable or the X, and then the return would be the dependent variable or Y. So in other words, risk is going to be the X variable, and then return would be the Y variable. So the return then would be a function of risk and vice versa. So that's why we would be hearing that the higher the risks, the higher the returns. All right. So I hope that is clear. Then expected return on assets, which would be the discount rate that we are going to get or we are going to use to obtain the present value of future cash flows. So expected return on the bonds or the investments in bonds or the assets would again be the discount rate. So valuation thus is obtained. And I've also would like to highlight that the future cash flows that we are talking here actually would be two. The principal, which would be using the present value of one because it is like one time normally, and then the interest would be periodic series of cash flows. Hence, that would be computed using the ordinary annuity of one. Unless if we're talking about serial bonds in which such would have, of course, series of payments even for the principal, but then that would be not covered here. Okay, moving on, the fundamental valuation model. So this is a review also about getting the price of asset at time zero. In fact, this is the present value. So we would like to know how much is the value of a certain bond or any asset that is to be received in a future time at time zero today. That's P sub zero. C F sub T is the cash flow expected at time T, a certain point in time. R is the discount rate, which is the expected return on the asset or investment reflecting assets risk. And N will be the number of discounting periods, usually years. Although we have learned from time value of money that the N could also change. And then the N could also be more, especially if we are talking about the compounding periods of monthly, quarterly, and semi-annually. So that would also multiply. But then if this is like 1 year and then monthly, so of course the first month would still be one, and then the second month would be two, and so on. But the rate, of course, would be whatever is the given rate. If we have the effective, of course, we use that the effective rate divided by the number of periods in a year. So we get now the I. So that's why we would be seeing a lot of books having here 1 plus I, because I is the periodic effective interest rate or periodic effective discount rate. We can also use that one. Then this model can express the price of any asset at time equals zero mathematically. Of course, this is going to be applicable for series of payments or installments and even for present value of one. So this is going to be applicable. And also this would be applicable, actually, if we're going to look at the formula, P0, these are the sum or the sums of the different present value of one or the present values of one throughout the period. So these are the given items. I repeat, the P sub zero is the sum of the various present values of one as computed. Then another learning point is that this particular formula is applicable both for the annuities as well as the different amounts of installments. So this is a powerful model. But then to simplify the ordinary annuity and annuity due, that's why we are going to make use of the shortcuts then as discussed in time value of money. Then marginal benefit of owning the asset. This is the right to receive the cash flows. You have to make sure that in any asset, there would always be benefits in whatever form, whether that's quantitative or qualitative and financial, but more in financial because we are under financial management. Then the other items would be the qualifiers, just in case they do not pass the financial, then we can still allow them to be accepted or passed if ever they have the qualitative items that are acceptable. But then that's just going to be secondary for those items that pass the financial. Moving on. So the marginal benefits must exceed or should exceed the marginal costs. All right. And then we can also say this under the cost benefit approach or analysis that the benefits must exceed the cost. And if that's the case, we have the marginal benefit or the net benefit. Yeah, that is also another thing of saying that although the benefits and costs must be marginal or additional or incremental, since we are focusing, guys, on the extra or additional, should we analyze items here in financial management, those items that are already irrelevant or sunk will no longer be included in the analysis. And also, as said, marginal costs and expenses, this would be the opportunity cost of owning the asset. So meaning the benefit foregone if we own or should we own that particular asset. While the benefit, as said, would be the right to receive the cash flows. The difference of the two should be positive so that we will continue holding or owning a particular asset, which is bond in this case. Bond vocabularies, we need to know the terms. For majority, this would be a review. Principal is the amount of money in which interest is paid. So for example, 1 million pesos and coming from, let's say, 1,000 bonds with a price of 1,000 pesos each. So the total amount is the nominal amount of the bond or the face amount of the bond. Maturity date is the date, of course, that the bond would mature. So this is the time in which the entire principal would be received. If that's one time, so we would be getting the entire amount. And then the interest, which is the final, the last payment would also be received. And therefore, the bond now would be terminated or would be closed. Then par value is the face value of a bond. A while ago, remember I mentioned or we discussed that, let's say, 1,000 bonds with a face value of 1,000 pesos each. So this means that each bond has a par value or face value of 1,000 pesos. And then this amount would be the amount that the borrower should repay at maturity, because we have to make sure that even if there are differences of the values, fair values of the bonds initially at time zero, but then at the end of the period, it should be that the entire amount should equate to face value to be able to settle the entire amount of bonds. Coupon is also known as the nominal rate. So this is the fixed amount of interest that a bond promises to pay investors. Although again, the effective rate would be different with the coupon because the effective rate would not be equal to the nominal rate. Bond indenture or indenture is the agreement, a legal document stating the conditions, the covenants under which a bond has been issued. Then I've mentioned a while ago the coupon rate, which is also known as the nominal rate. Going back to coupon, so the fixed amount of interest, that's the coupon, but the rate is of course the interest rate, in which we can obtain this by dividing the bond's annual coupon payment or the interest by its par value or the face amount. So let's say 100,000 and then divided by 1 million in the example. So that's 10% coupon rate. But then normally the coupon rate is stated in the contract. That's why it is also known as a stated rate. And let's say 10%. So to get the coupon, that's 1 million times 10%, and that's 100,000. So it's a matter of working back and forth or competing vice versa or vis-a-vis with each other. Coupon yield is the effective rate of interest, in which because of the values in the market, so we have to compute how much really is the rate that would make the face amount or nominal amount equal or changed to or would be converted to the fair value. So how is that computed? By using the coupon yield or the effective interest rate or the prevailing market rate of interest, and then that's to be used as the discount rate to compute the present value of the interest, as well as, of course, firsthand the principal. So as said, the current market price does not always equal its par value. Hence, the coupon yield or the current yield or the effective interest rate or effective rate or the prevailing market rate of interest would be used. Also, that is in the notion that assets which are investments should be reflective of their fair values. Now, as discussed a while ago, to be able to compute the bond's price, we have to make use of the basic equation, which is the bond price is equal to present value of coupons plus present value of principal. And we assume that these are the annual interests then. So we have here the present value at time zero, and this is the cash flow. C here would be the coupons or interest. So we have here the first period, second period, and the nth period, whatever that is, we are going to add. Also, we have to take note again that R here is the periodic effective interest rate, which is the nominal rate divided by the number of periods in a year. And at the last part, we have here the M, which is the principal. Then we have to multiply that with 1 plus I or R to the power of negative n, or make it a denominator. The n here is really the number of periods in the contract. So example would be that, let's say it's 2 years and that's annually, so n would be 2. But if 2 years monthly, so there are 12 months in a year, 2 times 12 is 24. But the R, if 10%, should be divided by 24 if we have monthly in 2 years' time. So another way also is to, another way is this shortcut which has been introduced in time value of money. So please refer this one. And I also introduced another way to that in which you can make use also of that shortcut in time value of money. So make sure that you've had good times in time value of money to be able to do this. Okay, so example, for timeline for bond valuation with annual interest payments. So assuming that we have a worldwide united 9 and 1 over 8% coupon, then with $1,000 par value bond maturing at end of 2019 and the required return assumed to be 8%. So to be able to compute, we need to know, of course, what these given items are. We have the given rate, 9, 1 over 8%. We have the par value for each bond, and then we have the maturity date at 2019. Then we have the discount rate at 8%, which is effective. This is the coupon or stated rate. And then we now have to compute the price. So to be able to compute that, we need to know first the present value of the principal. The present value of the principal is the present value of 1. To get the present value of 1, that is 1 plus I to the power of negative n. The problem is silent, so we assume this is annual. Also, there has been no mention of how many bonds there are, so we simply assume there is one bond. So 1 plus 0.08 or 8% to the power of negative number of n periods. And then it was not stated what was the beginning of the contract, so we just have to refer to the table of 2008 as beginning, and then n is 2019, so we have 11 years. So 1 plus 0.08 or 1.08 to the power of negative 11, and we get 428.88. So that's the present value of the principal. Well, we just have to take note that for this value, there are series of payments. So if we do not actually read properly the table, we might be tempted to think this is the present value of principal. But then this is the one because of this particular purple arrow, I suppose, or somewhat like blue. Then we have here $1,000. So at the end of the period, which is actually the definition of the payment or the collection, because this is investment, so collection of the principal. So that is $428.88. We also have to take note, guys, that this is investment. So the situation here is that we are actually investing in bonds. So a certain, let's say, corporation or even the government would be issuing bonds in order to get funds or sources of funds. That would be a financing scheme or method. And then we as investors would be investing in those bonds, and then we will be getting our returns after a certain period of time, the maturity of those bonds, and then we'll be getting, of course, the interest together with the principal. Okay, so that's the situation here or the case here. To continue, we have the present value of interest. So we are going to compute either the long method or the short method or the shortcut. In long method, so we have here the coupon payments, which is 9 and 1 over 8%. 1 over 8 is 0.125. So that's 9.125 divided by 100. So we get the percentage 0.009125 multiplied by $1,000. We get 91.25 for each period. And then we are going to multiply that with PV of 1 for each year. Or we can make use of the shortcut. So the shortcut is the amount of the periodic interest, which is $91.25, and then we multiply with the present value factor. To get the present value factor as a shortcut, that is the quantity 1 minus the quantity 1 plus I to the power of negative n all over I. So that would be 1 minus the quantity 1 plus 0.08, which is the rate, to the power of negative 11 all over 0.08. Okay, and we multiply that with 91.25, so we should be able to get 651.43. And then we add the two, so we get $1,080.31. Next, yield to maturity. YTM is the estimate of return investors earn if they buy the bond at P sub 0 and hold it until maturity. So they pay for the present value and then get hold of it until maturity. So this would be a case of financial assets at fair value, and then through other comprehensive income, if, for example, that is an equity instrument. But then if it is a debt instrument, this is now the financial accounting perspective, by the way. So financial assets at fair value through amortized cost because it is held until maturity. Then the YTM on a bond selling at par will always equal the coupon rate. This is also one insight. If, for example, the coupon rate is equal to the effective rate, so meaning the fair value of the bonds would be equal to the face value. Or to be able to sell a bond at, let's say, equal to face amount, so meaning have the effective rate as the coupon rate. And then YTM is the discount rate that equates the present value of a bond's cash flows with its price. Therefore, yield to maturity or YTM is another term for the discount rate or effective rate of interest or the prevailing market rate of interest. Next, bond premiums and discounts. So we have to take note of these situations, which would be the usual or normal case. If, for example, we invest in bonds, we do not expect that we pay equal to the face value or amount. Usually, again, it would be either higher or lower than the face amount or nominal amount of the bonds. So this is the case where the required return or the effective rate, required return also known as the YTM, another term, then not equal to the coupon rate. So in other words, the fair value or the bond's price, by the way, fair value is another term for bond's price, would not be equal to the par value or nominal value or amount or stated value. So there is a discount if the fair value is lower than the par value. So in other words, our amount or the amount that we pay for the bond is lower than its nominal amount. So that's why we get a discount. So this is an implied gain on our end since we are able to buy the bonds at bargain price. On another hand, if we paid more than the par value or nominal amount, so there is a premium, which is an implied loss because we paid more than the face value or amount. For the discount, by the way, in terms of rates, there is a discount if the effective rate of interest is greater than the coupon or stated or nominal rate. And that is the reason that if you look at these given items here, in boxes, we have when R, or the discount rate, or the yield to maturity, or the required return of the asset, or the prevailing market of interest, or the bonds price current rate, or whatever terms is greater than the coupon or the stated or the nominal interest rate, then there is a discount. Or if we state that in dollars or peso amounts or values, the bonds price or the current price or the fair value or the market value is lower than the par value. If the opposite is true, then that is premium. Now, if you are confused with these terms, although this is a review, I would suggest you familiarize with one item. If you are familiar with the discount, for sure the opposite is the premium. So that's what I did when I had the confusion as a learner. Next, on discount rates, generally, the greater the uncertainty about an asset's future benefits, then the higher the discount rate investors will apply. Of course, this actually meant that the greater the risks involved, then the higher the benefits, because there were also higher discount rates. The discount rates actually are the evidences for or the indicators that there are risks or greater risks involved. Then when discounting those benefits to the present for a while, this would mean that the present value or fair value would be lower. So I hope that makes it clear, or that summarizes so far. Next, this is for semi-annual compounding. However, I've already mentioned that the R here, the nominal rate, if equal to the effective rate, so that's why it would be R, but I would really suggest that if it is going to be effective, then you think of I or whatever dummy variable that you are thinking. So use the effective rate and divide that with the number of periods in a year. If it is semi-annual, divide it by 2. If it is quarterly, you divide that by 4. If monthly, so divide it by 12. If by monthly, so divide it by 24. And then you can also notice that for the interest, the coupon payments, by the way, coupon is synonymous to interest. So you divide that as with the 2 or 2 for the factor that was divided with the effective interest rate. Also, if you are going to think about, you don't need to divide this by 2 if you use already the periodic interest rate, let's say 10%, and this is semi-annual. If you multiplied to the face amount 10%, so you still have to divide this by 2. If ever, for example, let's say you divide that by 2, the 10% already, that's 5%, so no need to divide by 2. That's also one thing that you should take note, all right, about this one. And then the last one, the lesson here is for example for the face amount. As what I've said, that is 1 plus I to the power of n. So the I is the periodic effective interest rate and n is the number of periods. That's why you can see here 2n, which is the number of years times 2 because that's semi-annual. So you can make use of this model or the shortcut model. And that's why, for example, for a T bond with par value of $1,000, maturity of 2 years, and a coupon rate of 4%. So this would mean that to be able to compute the present value, so that is $40 coming from $1,000 times 4%. That is the coupon payment or interest payment, or in our case, our collection, because we're the investor, payment coming from the borrower or the bondholder or issuer. So 40 divided by 2, that's $20. And then the R is going to be the effective interest rate, which is 4.4% as given, 0.044, and you divide it by 2. We divide it by 2 because this is semi-annual. Okay, so we will be able to realize also later on that the more periods there are, the bigger the interest rate, then the lower the present value. So that is also one thing that we should take note. And the more frequent we compound an item, the lesser the present value, because this means that the money will have to earn more to be able to equate to the principal. So that's why we should be getting lower present value. You can actually compute that or verify that by computing here the present value, and then that is annual, or assuming that is annual. So to simplify, if we are going to do that, so we do not divide this by 2 and we do not divide this by 2. If you are computing, then you will be able to get 992.50. At this point in time, you should be pausing to be able to verify that and compute that in your end. I repeat, we can simply do this by not dividing the amount of coupon by 2 and the rate by 2 if this is annual. So we will get $992.50, which is, of course, in terms of difference, that's 0.07, but which shows that should we have lower number of periods, and then let's say we did not have more periods to consider, so this means that our present value factor would be higher and we would have higher present value factor, or we would be saying that the more periods there are, the bigger the interest rate, then the lower the present value there would be. So I hope that is also clear. Another topic would be the economic forces affecting bond prices. We have the following items. So time to maturity. If there would be more time, of course, this would have lower present value factor or factors and lower present value or fair value or price of the bond. We have to take note again that the bond prices would converge to par value plus the final coupon or the interest payment with passage of time. If let's say 10 years, this is the present value or P sub 0 at this time, that would equate to par value at the end of 10 years. Also, interest rates would be a factor. So we have to take note that the bond prices, the fair values or present values, actually are indirectly related or inversely related with the interest rates, such that the higher the interest rates, the lower the present values. They move in opposite directions. The more, if there are more risks involved, as what we've said, because it's just basic interest, but we all know in financial management that there could be more risk like credit default risk, liquidity risk, and many more, which would be tackled in other chapters, not here. So that would result to more or greater interest rate, and thus would be having lower bond prices. So changes in interest rates have larger impact on long-term bonds than on short-term bonds, of course, because the bigger the years there are, so the bigger the chances that we will be compounding, and therefore the lower the present value factor, the lower the bond prices. Short-term bonds, we have lower periods to begin with, so lower times to be exposed to risk and lower times to be able to compute the present value factor. So that would result to higher present value factor and higher bond prices, again as explained. Then we can see here the relationship between bond prices and required returns. This is the graph. We have on the x-axis the required return in percent, and we have the bond price in dollars. In this case, to be able to compute the bond price in dollars, which is y or f of x, then we need to compute that, or we can compute that using the required return in percent, and that is the x, or the, of course, independent variable. So this is the discount rate or the yield to maturity or effective market rate of interest or effective rate or the periodic effective rate of interest and other terms, of course. So we can notice that with 6% coupon rate for both, so same nominal rates, but different required return in percent here on the x-axis, but overall the same, of course. So the difference is that we have different number of years. So for 2-year bond, we can notice that with the given rates of the required return in percent for the discount rates, so it would tend to go lower. Of course, that's normal. Since the higher the discount rate, then the lower the present value factors would be, and the lower the bond prices. So we can notice that here. But then, the greater the number of years, so the more chances of compounding, and then with the higher or increasing rates, the lower the bond price there would be. So in other words, the cheaper that we are going to receive or pay for that, or to invest in the bonds. So we would say that it is much better though that we think of long term should be invest, because we would be able to acquire cheaper bonds if we are again thinking of the long term. Then interest rate risk, another term, is that the risk would change in market rates because of fluctuations in a bond's price. And then also, if there would be losses as a result of an anticipated changes or unexpected changes in market interest rates. So this would be the interest rate risk. Then real return is actually the difference between an investment stated or nominal return and the inflation rate. So whatever is the coupon rate of interest or the nominal rate, then that's not yet the real return. So we can deduct the inflation rate to get the real return. And then the nominal return is stated return offered by an investment unadjusted for the effects of inflation. So no inflationary factors considered here. So that's why the nominal return would be higher than the real return, because if we deduct inflation rate from the nominal return, we get the real return. Then treasury bond yields and inflation rate. In this graph, we have here the years on the x-axis and the percentages on the y-axis. Then the blue is treasury bond yield to maturity, meaning the effective rate of interest, and the inflation rate. We can notice that overall they are actually changing dramatically, which would be normal. So they are not actually constant, and that's the reason that there would be changes in the values of the bonds. We can also notice that they have been changing up and down, so very dramatic in terms of change. Then another learning point here is that in the treasury bonds value, it actually reached its highest high, or the peakest peak at certain time from 1980s. So although it reached there, we can also say that it's not actually forever, or it's not going to last that long, because it would change. But overall, like in the long run, we would be able also to achieve the betterment from these investments if we think long term. So if we are a trader here, meaning we really sell bonds, or we trade bonds, buy and sell them in the short term. So that's why we would be really experiencing the fluctuations and the gains and losses most of the time. So for the Treasury bond YTM, when the inflation rate would increase, also the Treasury bond yield to maturity would be increasing, because the more risks there are, especially also because of inflationary factors, so the bigger the discount rate. Now, a while ago, I understand that we've discussed about the real return, in which we deduct that from the nominal rate. If we go back, the real return is the real. So the word real is clear. It's the real return. So in other words, the earnings, the gains that we get from the investment, that is really true. The nominal is not yet adjusted for inflationary factors. Is discount rate different from real return? Yeah. The discount rate is the yield to maturity, or the prevailing market rate of interest. That is the interest current at a certain point in time. So we can also say that it is the interest rate at that particular point, not necessarily the real return overall for that particular investment. That's also one thing that we should take. Then for the last item for discussing part one, we need to know the difference between primary and secondary markets. For primary market, this is the first time, this is the market in which we made the sale of the bonds. If we are having stocks here, we would be saying the IPO, initial public offering. So for our bonds, this is the initial sale, the first sale, very first sale of the bonds by issuers or the issuing companies who would like to have monies for their financing or finances to the company, then these are issued to large investors or syndicates. For secondary market, this is the time in which after the initial sale of bonds, then the bonds are being transferred from one person to another or from one entity to another. Trades in the secondary market do not raise any capital for the issuing firms. Yes, that's true because such would only result gains and losses between or among the traders, not anymore with the issuing company or the very first entity issuing the bonds. Thank you very much for the time of listening to the first part, and then make sure to review time value of money concepts for the present value computations, and watch out or stay tuned for the second part. Thank you very much and God bless us all.